It is Bitcoin halving week. So this on the 20th this week, April 20th, the Bitcoin block reward was cut in half. This is an event that happens once every 4 years, and I've been around for this is like my third halving now, but it still raises a lot of questions and a lot of confusion in the community. So we thought we'd start by clarifying a little bit what happened, what does it mean, and what is the implication moving forward from this. So to dive straight into that, well, to understand what the Bitcoin halving is, we kind of have to understand how Bitcoins come into circulation. And so Bitcoin is a network, and the network is maintained by people running their computers and contributing this computing power to safeguard this network on a global scale. And in exchange for that computing power, every time a block is added to the blockchain, there is a minting event triggered where new Bitcoins are created out of the network, out of nothing, effectively, and given to the miners or the computing power that generated that block. From the very start of Bitcoin, this has been a fixed rate. So when Bitcoin first started back in 2008, I believe, is when the Bitcoin network first spun up and started running, every 10 minutes, when the new block was found, mathematically on average, so obviously a little give or take there, but every block, every mathematically averaged 10 minutes, 50 new Bitcoins were created out of the protocol, out of thin air, and distributed to the people supplying the computing power to the network. In that way, 10 minutes at a time, one block at a time, every single Bitcoin was created and distributed to the participants of this network. So it's a very much planned and a very fair and participatable and expected distribution model for how these coins are created and then distributed. Anybody can participate by simply adding their computer to the network and adding processing power to this mining activity, and anybody can, get lucky and find a block if they beat the mathematical average. So from the start, every 10 minutes, new Bitcoins come into existence, 50 at a time. Every 4 years, that 50 got cut in half. So, after that first 4 years in 2011, I believe, we had the block reward cut down to 25, and then, again and again, and now with this most recent block reward halving, we are now down to just north of 3.
3.125.
Yeah, 3.125. So that's 3.125 new Bitcoins are created out of this mining process every 10 minutes. If we now look at the total amount of Bitcoins in circulation, 2.125 Bitcoins per 10 minutes now shows us that the Bitcoin inflation rate, so the rate of new Bitcoins being created and entering the circulating supply of existing Bitcoins, is now below 2%. APY. So less than 2% of existing circulating Bitcoin are being generated each year now. 4 years from now, it's going to get cut again down to like 1 point, less and less. But basically, this week on the 20th, we had the block halving event. Since the 20th of April, the amount of new Bitcoins being generated by the network, the mining of Bitcoins by the network of participants, is now reduced by 50%. And will never be higher than it currently is, never be more than 3.125 every 10 minutes. And because of that, Bitcoin has kind of crossed a threshold here where its effective inflation rate is now lower than basically every other asset out there, every other cash asset out there. So, under 2%, that's cheaper than, fiat currencies, government dollars, that's cheaper than basically anything. So This was a big-time planned event. Everyone knew it was coming since the very beginning of Bitcoin, so everyone has been kind of excited about it. I've definitely seen some confusion, people thinking that it means the supply gets cut in half or something happens to like coins that you currently hold. None of that will affect you if you're not participating in actively mining Bitcoins. You won't really notice a difference. The only difference is that the miners are now getting less. And what that means is they have less ability to sell new Bitcoins. And so the idea here is that, the reduced supply with a consistent demand. So as long as the demand for Bitcoin doesn't drop more than the supply, then the price should increase. And that's where a lot of models out there from like these big analyst firms are anticipating a run up in Bitcoin price in the coming years, and that run is basically uh, a product of this supply demand model, where now the supply is being reduced while the demand is potentially actually increasing as institutional players are trying to take market share of the ETF space.